All right, hello everybody. Welcome back into the NASDAQ Option Superstars program. Wanted to record a video here today with it being such an active day to start the week. It's been an active last 4 or 5 trading days, so I wanted to cover what we did here today. We took a couple of trades off. We also opened up a new position on Amazon, so I want to review those trades, especially for those of you that have just joined. We've had a number of new people join over the past week and a half, 2 weeks, so a big welcome to all of you. I do like to do these videos on a semi-regular basis. I won't do them every day, but if I start to see things shift in the overall market, if we have an active stretch, I do like to review what we're doing and why we're doing it. So let's go ahead and dive in and talk about the market here today. Today was one of the more active sessions that we've had all year long. Huge range in this market. Big move to the downside. It came on big volume, big move in volatility. And the reason I want to point this out, we are coming off of a stretch going back into July and even into part of June for that matter. That was incredibly frustrating for us. We talked about it in the videos. We talked about it in the Slack group. It was not a fun stretch because we were in a one-way move to the upside. It came on lower volume, lower volatility. And as an options trader, that's the dreaded environment. I can do a lot of things as an options trader. There's a lot of strategies that we can use to react to shifts in market conditions. The one market that is by far the most difficult to be active in is that one-way move to the upside, which we had in the month of July. And we felt it in our results. Right? We had some lengthy discussions in the Slack group from people saying, hey, why are you so bearish here? Why are we selling call spreads? Why are we taking bearish trades when the market is so strong? And what I talked about was that long term, the pace that we saw in the month of June and July, it was not sustainable. The numbers were not backing up taking bullish trades. And the problem with newer retail traders, and when I say newer trader, I'm talking about people that have gotten started in the last couple of years, because during that stretch, you have not seen many moves to the downside. It's been basically a one-way shot to the upside. And it's very easy to get into that trap of thinking that's just the norm. The market's going to move higher every day, every week, every month. If you get a stretch where you get some selling, wait a couple of hours, buy the dip, and we'll head right back to the upside. And it was frustrating for some of you because here we are, trying to put on neutral to bearish positions, trying to play for a market pullback, and the market just kept heading higher on us. And what I mentioned in the Slack group was it was an outlier move. Even though the numbers were against that type of move, the probabilities didn't back it up, it's still statistically possible. It just wasn't probable. And I was structuring our trades to put the odds in our favor long term. Now, was I expecting the market to fall out of bed like it has here the last couple of days? No. And I mentioned, I don't want the market to crash. I just want good two-way action. I want back and forth movement because I know it gives us better volume, better volatility, just a better overall environment to be active in. And we have seen the results just over the past couple of weeks really start to improve. We've won 8 out of the last 10 trades. So it's just a prime example of what I was talking about back in the month of July. And I know it's difficult because for some of you, you were just taking my word for it, right? You were just saying, hey, I'm just going to take your word for it. I'm not seeing it, Mike, but you're saying the numbers are in our favor long term, so I'm just going to continue to trust it. And this is why we do what we do. We're not basing our decisions off of a hunch. We're not basing our trades off of a hunch. We're basing our decisions off of numbers and statistics. Did I know the Fed was going to lower rates? Did I know that Trump was going to raise tariffs again on China? No, I didn't know that, but it doesn't matter. The numbers dictate everything that we do. And we got so overbought, we knew the numbers favor either a period of consolidation or a pullback. Now, in this case, obviously, we're getting a pullback price-wise, but we didn't need it. All we needed was a period of consolidation or a nice, healthy pullback. We could have made money in both of those. Obviously, this move lower has helped us out. So you can see we did test a pretty key support level here today. We did hold it into the close. We tested 200 period moving average there. The volume was over 150 million shares. We were in the last couple of weeks, actually going back into July, into June, I mean, it was a struggle to hit 50 million shares on a daily basis. And I mentioned that's a fraction of what we see historically. We're seeing 3 times the volume over the past couple of days than what we saw all of the month of June and July. The activity is much, much improved. Now, I don't expect this to stay as active either. I mean, as extreme as it was back in June and July, we're already starting to get to an extreme on the downside here. In the near term, I'm not saying the low is in long term. I'm just saying in the near term, we're probably going to get an attempt at a bounce here over the next few days. And we'll talk about that more in just a second. So I just wanted to point that out for those of you that are newer. Some of that it might not make sense to you, but those of you that were active in the month of June and July, you heard us talk about this. And this is just a textbook example of how numbers will always normalize in the end. Statistics will always come around in the end, and we are seeing it here this week. Now, how does this shift what we're going to do in the near term? Let's talk about some trades that we closed out here. We closed out of 2 more trades here today on Twitter and Micron. Those are the last 2 trades on the position sheet that I'm showing you here. We had call spreads on both of these. Let's talk about MU first. Let's talk about Micron first. This was a trade that we put on back on July 11th. We sold the 45-47 call spread. So for those of you that are new, we sold the 45 call and bought the 47 call at the same time. It was a risk-defined trade. We collected 60 cents or $60 per spread to put that trade on. We were risking around $140 per spread. It left us with a neutral to bearish position on Micron. Now, for those of you that were in this trade, it was painful for the first couple of weeks. We were underwater. I had questions coming in Slack. I had some less than pleasant emails coming in from people that were in this trade stating, what do I do? Do I take the trade off? It's working against us. I'm getting killed on the position. You name it, I heard it at the first couple of weeks after we put this trade on. And what I talked about was because it's a credit spread, because the time decay is working in our favor, we have the ability to hold that trade longer. It has the potential to recover faster because the time decay is helping us. Fortunately for us, the market has rolled over, it has pulled back, and we went from a pretty large loss to a nice, decent profit. We closed out of $35 of profit per spread using our risk rules where we risk around $500 per position. It gave us about $105 of profit. So really nice rebound on the trade, no doubt about it. I wish I could tell you that every trade that starts underwater is going to recover like this. It doesn't always happen, but in many cases, it's highly probable that at some point during the lifespan of that trade, that stock is going to reverse. It's going to allow you to take a smaller loss or a small profit like it did in this case. So you have to be patient. If you're using proper risk, where the outcome of one trade or one series of trades is not going to wipe out your account, you're going to have a far easier time staying patient on these positions. So could I have held and gone for the larger winner? We still had $25 of profit potential had I held the trade. Why did I close this one out? Because we went from a decent sized loss to a really nice profit, I wanted to book the profit while we have it. We have seen over the past number of months, every single dip that we have had has been bought up. The dip continues to be bought almost religiously here. I don't want to have a buy the dip or a turnaround Tuesday, whatever you want to call it, have the market higher over the next few days and have this thing go right back underwater. I want to book the profit, free up the capital, and just move on to the next series of trades. So that's why we closed it out. Had we been in a market that has seen more sustained selling pressure, I would have been more open to holding the trade longer, but you guys have seen it. I mean, if we get a couple days of selling, you've got to be active. You've got to be able to book some profit because we just have not seen any long stretches of downside pressure. So that's why we took the Micron trade off. Very similar approach to Twitter, other than the fact that we were never significantly underwater on this trade. But I wanted to close out of the profit here today because I don't want to get caught on a big reversal over the next few days. The market's oversold in the near term. I don't want to get caught, have this thing reverse right back to the upside and go from a nice profit to a loss. I want to book the profits while we can, free up the capital for our next round of setups here this week. So on Twitter, we put this trade on at the end of July 31st to be exact. We sold the 43-45 call spread, meaning I sold the 43 call and I bought the 45 call at the same time, and I was utilizing the August 16th monthly options. We collected $61 per spread. That's the most I can make on the trade. And our capital required to put this trade on, again, right around $140 per spread. We closed this trade out today for around 21 cents. It gave us $40 of profit per spread, or around $120 of profit if you're risking around $500 per trade like we do with our model portfolio. So why did I close Twitter out? Because we got a nice move to the downside. I'm concerned about this dip being bought over the next few days. As we get closer to expiration, options become more reactive to changes in stock price, meaning the P&L of your options positions will get more active the closer we get to expiration. So knowing that, I didn't want to go from a really nice profit where we're between 50 and 75% of our max profit and have that thing turn around and give it all back and end up taking a loss on the trade. So we closed it out, booked a nice profit, and we're moving on to the next trade. And that next trade happened to come on Amazon. So one of the positions, one of the stocks on our list that has gotten to a very oversold condition is Amazon. Symbol AMZN. Now, some of you might be intimidated by Amazon. It is an expensive stock. I fully realize that. Okay, I don't deny the fact that these options can get very, very expensive. But we'll circle back to this, and I'll talk to you how we can drastically reduce the costs of the trade strictly by using a credit spread. So let me take a look at the chart here. I'll show you the whole basis for this trade here. I mentioned Amazon is oversold. What makes it oversold? How did I come to that opinion here today? Let me show you as soon as these charts load up. I'll zoom in to the chart of Amazon so you can see it. One of the indicators that we like to use on the charts is what we call our pulse indicator. And it indicates overbought and oversold conditions. Notice on the pulse indicator, it's this red and yellow histogram towards the bottom of my chart. Notice how the last 4 bars there on Amazon have all showed up as yellow. When you see a yellow bar there on the pulse indicator, that tells us that we're between a 1 and a 2 standard deviation channel move on the downside. For those of you that are not numbers or statistics people, when you get to an extreme like this, it means the chances of this move continuing to the downside, they're slim. Are they possible? Is it possible for the stock to continue moving lower? Yes, it's just not probable. Chances are when you start to hit a 1, a 2, a 3 standard deviation move, oftentimes what you're going to see going forward is a period of consolidation or even a reversal in price. In this case, we're at an extreme on the downside. We're between a 1 and a 2 standard deviation move on the downside. Chances are here, we're going to start to get a little choppy. We could potentially even bounce to the upside. I'm not saying we're going to go back up to the highs. I'm not saying we're going to get an explosive move to the upside. We don't need it. We're just overdone. In fact, we could see this thing continue moving lower in the months to come. I do not care. I'm saying in the near term, over the next 3 to 5 days, there's a very high likelihood that at some point this thing is going to bounce to the upside. So because of that, because of the pulse indicator printing 4 yellow bars, we came over today. Let me pull up Amazon. And we put on a pretty aggressive position. I don't normally get this aggressive, but we're just in a very active market where I wanted to take advantage of this extreme. So we actually utilized some very short-term options. We utilized the August monthly options, which are now down to 11 days left to expiration. You can see that number in parentheses right there. When you start to get this close to expiration, the option prices become very, very active. You're going to see these things really move. As a result, I know some of you had a difficult time getting filled on this one this afternoon. When you just trade these active options, it's better just to put your order in. You can adjust it by a few pennies, but let it work. Amazon was all over the map this afternoon. I didn't get filled immediately either. It took some time. Price action was kind of bouncing around, then I finally got filled at 77 cents this afternoon. But let me pull up the trade. We ended up selling a put spread. Now, for those of you that are newer to credit spreads, why do I like to sell so many credit spreads? Because they're very forgiving trades. They're going to give you a much higher winning percentage long term because you have 5 different ways of making money on the trade. If I just buy an outright call or a put, number one, it's way more expensive. It also leaves me with a very aggressive position. Okay, you're going to have a higher profit potential, but you're also going to have way more risk. And you only make money if that stock moves in your favor quickly. If I want to be bullish on Amazon trying to play a bounce here, if I buy a call, the only way I make money on Amazon is if it makes a big move to the upside. By selling a put spread like we did today, I actually gave myself 5 ways of making money, which you'll see in just a moment. So we came in, we sold the 1710, 1707.5 put spread. It's a mouthful. So let me go ahead and load up some additional strike prices so I can this in here. So I'm going to come to the 1710 puts. I'm going to right click I'm going to go to sell and I'm going to select vertical. It brings up an order down at the bottom where I am selling the 1710 put. And then also, according to our alert, I wanted to buy the 1707.5 put. Now, why am I doing that? Why am I also buying the 1707.5 put? Because I want a risk-defined trade. Amazon can move. It can move very quickly. I'd rather cut the cost of the trade in a big way. If I just come in and buy an in-the-money put, we're talking about thousands of dollars per contract. It's just too much risk for many people. With this trade here, I got filled at 77 cents. Let me just go ahead and use that as our number here. If I click on confirm and send, I can put this spread on and only tie up $173 of capital per spread. And that's the most I can lose on the trade. Okay, so you can see the order confirmation box here. The $77 that I'm collecting up front, that's the most I can make on the position. That's my max profit potential. My maximum risk is $173. Now you're looking at that saying, why am I risking 173 to make 77? Isn't that going against what a lot of people are taught? The reason why I'm willing to accept this type of a risk-reward ratio is I have such a high probability of success. I've got 5 ways of making money on this trade. Okay, my break-even point's at 1709.23. That number is calculated by taking the 17 put that I'm selling. I'm going to subtract the 77 cents that I collected to put the trade on. That gives me my break even. I don't care if Amazon moves up, down, or sideways. As long as it stays above 1709, I can make money. The current price of Amazon's at 1765. We've got a pretty decent cushion here. Ideally, I want the stock to move to the upside, but it doesn't have to. If it just stays sideways here, if we kind of drift higher or lower, I'm okay with all of those scenarios. The only move that hurts me is a big move lower below 1709, which I'm not expecting to happen because this market's already oversold. So there's 3 different ways directionally that I can make money on this position. I also make money from time decay adding up. Every day that passes, the time decay works in my favor. And I make money if volatility decreases. I think we would all agree that volatility has exploded the last few days. You can see the VIX on the left-hand side of my platform is all the way up above 24.5. That is an extreme on the upside. It does not typically stay this way for very long. Oftentimes when you get volatility to expand, like it has, it'll typically stay that way for a couple days, maybe a couple weeks at a time. So we're already in day 3 or 4 of volatility moving higher. Chances are over the next week or two that volatility is going to start to contract. As volatility starts to move lower, it causes the options to lose value. It causes the options to get cheaper. With a credit spread, we take advantage of that volatility moving lower. That's the 5th way that I have of making money on this position. So if the stock moves up, down, or sideways, I'm okay in all 3 scenarios as long as price action stays above 1709. I make money from the time decay adding up, and I make money if volatility decreases. There's my 5 different routes that I can go to make money on this trade. So a lot to like about this position. Now, this is probably going to be a trade. If we get a market bounce here tomorrow or into Wednesday, this is probably going to be a trade that we can take off relatively quickly. Now, where's my target zone? The 77 cents that I collected to put that trade on is my maximum profit potential. My target is 50 to 75% of that number. So when I can keep 50 to 75% of whatever I collected to put that trade on, that's an acceptable range to close out of the position at. That puts my target level at 19 to 38 cents. If I can buy this spread back for between 19 and 38 cents over the next few days, that's exactly what I'll do. I always start my closing order at that 75% number. So right now, my closing order on the Amazon trade is at 19 cents. I'm looking to buy it back for 19 cents per spread. If something changes, if we can't quite hit that 19-cent number, and all of a sudden the market looks a little vulnerable again, and I feel like the market's going to head back to the downside, as long as I'm in 50 to 75% of my max profit window, I can go ahead and close out of the position. So maybe we close it out at, maybe I can close it out at 25 or 30 cents. I can certainly do that. Anywhere inside of that 50 to 75% window is acceptable. Now, of course, we'll certainly let you know on our side when we're taking action. I'm not going to leave you hanging. You'll always know when we close out of a position in real time. All right, so ideally, what would cause us to make the money on this trade the fastest? If I can get a bounce in Amazon, if it happens quickly and volatility starts to collapse, that would allow us to make money faster on the position. So That is our new Amazon trade. We'll continue to track it here over the next few days. And then also, too, I'm looking to get active this week. I would love to get 5 new positions on this week. We typically shoot for between 3 to 5 trades, new trades each week, and I would love to get 5 on. I want us to be active, and we will most likely take a look at some additional long call and long put positions here this week. We've been trading a lot of credit spreads here lately just because that's what the market's given us. And because they're more forgiving trades, even though we don't have the home run profit potential with them, winning 8 out of the last 10 trades, I mean, we can see why it can be so beneficial to have those credit spreads as part of your overall portfolio. All right. Now, for those of you that are new, we will be holding a Q&A session here this week. I'll get the login instructions out here over the next 24 hours. We'll get you all the details. Want to give you an opportunity to log in, ask questions in real time. We can review some things about the program. Gives you a great opportunity to get some instant feedback. If you can't attend live, I know many of you are busy. We will record the session and we'll post it so you can review it at a better time for you. So again, I'll get those details out here over the next 24 hours or so. As far as our other open positions go, we initiated a short put spread on Netflix last week. We need Netflix above 307.5. I was not expecting this big move lower here to start the week. Right now we're sitting at 307.63. Netflix was down about $11 today. We do need Netflix to bounce higher from here. If we just sit here, we can still make money. I just need it to stay above 307.5. So any type of a move to the upside here is okay. I still like the position. We just have to be patient here, let it battle back for us. And then we do still have 4 short call positions on, short call spread positions on. Let me clarify that. These are short call spreads. And on all of these, CRWD, Chewy, Pins, VXX, all of these, you can see the first number listed here in the position line. On CRWD, we're short the 100 call. Chewy, we're short the 35 call. Same goes for Pins. We're short the 35 call. And then VXX, we're short the 27 call. We need price action to stay below those numbers. Okay, so on all of these are neutral to bearish positions. We still have all 4 of these on. We'll see what happens. Want to make sure we are diversified here. So you can see we still have some bearish positions on. We started to sprinkle in some neutral to bullish positions as well. The diversification should really help us out here going forward. We've been leaning neutral to bearish now for the last number of weeks, and we'll start to get more balance in our portfolio here in the weeks to come. If you have any questions on our activity from the last few sessions, if you have any questions on what to expect here the rest of this week, feel free to log into Slack. You can always ask inside of the general channel inside of Slack. You can post a comment inside of the NetPicks app, or you can email me directly, mike@netpicks.com. All right, so I'll be back with you over the next few days. Hopefully we can get a handful of new positions on over the next few days, and we'll go from there. So enjoy your evening, everybody, and I'll talk to you over the next few days.